Welcome back, everyone. In this video, I'm going to demonstrate the difference between direct recognition and non-direct recognition life insurance policies, which one is right for you, and how does this affect your ability to implement the infinite banking concept. Well, that's what this video is here for, so stick around to find out. There are two types of recognition when it comes to whole life insurance policies. There's direct recognition and non-direct recognition. The differences are primarily going to affect dividends and policy loans. Just as a quick disclaimer here, if you have no idea how whole life insurance policies work, this is probably not the best video to start with. I'll link below to our What is the Infinite Banking Concept video, and that will get you started. If you're still here, I'll assume you have at least a basic idea of how a whole life insurance policy works. Okay, so imagine you have two almost identical whole life insurance policies. Same insured person, same death benefit, same duration of payments. Everything is the same except the recognition type. Let's just say that policy A is direct recognition and policy B is non-direct recognition. If you were to pay your premiums on both policies every year, both of them would perform in exactly the same way, as long as you never used policy loans at all. So, if you aren't accessing the cash value in the policy via policy loans, or any other way, then they will grow exactly the same along the same schedule, assuming they're identical in every other way. The difference here is in how the dividends are calculated when the cash value is accessed. In policy A, the company directly recognizes when you have a policy loan outstanding. Let's say you have $20,000 of cash value available in the policy, and you take out a $10,000 policy loan. You make no payments on this loan for 1 full year. Imagine that your dividend would have been $2,000 if you had no policy loans. In a direct recognition policy, there are a few different ways that this might play out. Which one applies to you is going to depend on the specific insurance carrier and policy contract type you're using. Let's look at a few of these possibilities. Scenario 1. The percentage of your cash value that is loaned out is applied to your dividend as a reduction. In this example, you loaned 50% of the total cash value. That means 50% of your dividend is paid. Instead of a $2,000 dividend, your policy earns a $1,000 dividend. Scenario 2. The percentage of your total cash value that is loaned out still earns a dividend, but that portion is reduced. So if you loaned out 50% of your total cash value, that 50% that remains is unaffected. The other 50% is reduced, for example, by half. That means you earn a $1,000 dividend for the portion that is not loaned out, and you get another $500 dividend for the portion that has a loan against it. That would mean that your total dividend on this policy for this year is $1,500 instead of $2,000. The exact amount of reduction is going to vary by company and contract type. Scenario 3. If you have any policy loans out whatsoever, regardless of size, you earn no dividend. This makes the math rather easy. Your dividend would be $0. Now, to be fair, I'm only aware of one insurance company that does this, but there could be others. So far, we've focused on the downsides of direct recognition, but are there upsides? Well, sure. The interest rate on these policy loans is generally lower than their non-direct recognition counterparts, and the interest rate is fixed. instead of variable. So again, you take a $10,000 policy loan and keep it out for 1 year without making any interest payments. How much interest would you accrue in that time? As I record this in November 2023, direct recognition rates are around 4%. $10,000 times 4% is $400. Policy loans use simple interest, so it's actually pretty simple to figure this out. Now, if you're financing a really large purchase, such as a house, and you need to keep the policy loan out for a very long period of time, having a fixed interest rate may be important to you. Just make sure that you know how your dividends are being impacted. Okay, now let's talk about non-direct recognition. In some ways, it's the inverse of how direct recognition works. In non-direct recognition, the company does not recognize that you have a policy loan outstanding. So let's use the same example as before. You have $20,000 in total cash value, and you take a policy loan for $10,000, making no interest payments for 1 year. Imagine that your dividend would have been $2,000 without the policy loan. In this arrangement, you would still earn $2,000. Now that's true if you take a policy loan for $10,000, $3,000, or all $20,000. The insurance company does not factor in the amount of loans or the total volume of loans at all. The downside of this arrangement is that the interest rate is going to be a little higher, and it's a variable interest rate. At the time of this recording, non-direct recognition rates have been around 5% for several years, but interest rates are rising. We have some clients at Perfect Spiral Capital that are currently looking at about 5.5% for their policy loans. And generally speaking, the rates on your loans, if they are variable, are going to update each year on your policy anniversary. So, which one is better, direct recognition or non-direct recognition? The short answer here is it depends. Personally, I love non-direct recognition, and that's how my wife and I choose to finance things that we need to do, both for business and household needs. I really like the idea of not compromising my policy's growth over time. After all, we use our policies a lot. Still, direct recognition could be the way to go if you aren't planning to access the policy's cash value very often, or if you know that you need to finance something over a very long duration. If you're looking at this from a strictly growth standpoint, though, let's analyze the numbers a little bit more closely. Same example from before. Direct recognition, scenario 1. You earn a $1,000 dividend, but you have a $400 interest cost. That's a net return, if you want to think of it that way, of $600. Direct recognition, scenario 2. You earn a $1,500 dividend, but you have a $400 interest cost. That's a net return of $1,100. Direct recognition scenario 3. You earn a $0 dividend, or in other words, you don't earn a dividend, and you have a $400 interest cost. That's a net cost of $400. And then finally, non-direct recognition. You earn the full $2,000 dividend. But if we say that the interest is 5.5%, that means your interest cost is $550. That's a net gain of $1,450. So in this example, looking at this very specific set of circumstances, the clear winner is non-direct recognition. However, it's a lot more complicated than this when you really dig into it and consider all the different ways that you might utilize your policy. I also need to say, dividends are not guaranteed, so it's certainly not like you know in advance what the dividend is going to be. Also, in this example, we made no loan repayments for the full year. Because policy loans are simple interest and all of your payments go to principal first, making payments has a huge impact on what your net cost will be in each scenario. We'll have another video out relatively soon to dive more into policy loans. When it's ready, I'll come back and add a link below this video. For a more detailed analysis of how this might apply to your own specific set of circumstances, please check the description box below for a link to our booking page. You can have a free consultation with any of the agents on our team, and we can see how this might apply in your life. If you prefer to do some independent study first, you'll also find a link to my book. I hope that clarified the difference between direct recognition and non-direct recognition. Thanks for watching, and we'll see you on the next video.